from Shore & Partners. Good to see you. We were talking about that exact thing just before we came on air. Was it volatility? It's changing environment.
It is. I mean, it's one thing to read about it, it's another thing to live through it. And I think a lot of people have been shocked at just how quickly things move. In our morning meeting discussion this morning about the quick reversal in the US overnight, nobody could explain why.
Yep.
It was all doom and gloom a day ago, 2 days ago, and then overnight it was all positive, and nobody knows why. So what does that mean for tomorrow? Just makes stock picking a lot harder, but it also reminds people to focus on the longer term, because I can't predict short-term share price movements, and you go nuts if you tried.
Absolutely. Philip, I always thought it would be a good fit for Xero if they wanted to turn into a fintech or sort of provide financing for their business clients. But what do you think of
It's clearly
Tyro?
a good fit for someone. It was a market darling 2 years ago, if you look at that chart. And then, of course, we had COVID and saw small business struggled. I believe they had a trading update last week, which was positive. They talked about cost out and volumes holding up better than people expected. So it's very easy to be pessimistic, retail, anything consumer driven at the moment, and say, well, we're heading in for a recession, so sell. But as we saw, I think Bank of Queensland last week and Tyro also last week, that perhaps we're not crashing as hard as people thought. So I'm more interested in the fundamentals that came out last week with Tyro. I think it was up on the day. Notice today hasn't really moved, despite them admitting that there's a number of people circling. So I agree, when markets have corrected the way they do, some good businesses get sold off. And if you're a genuine long-term investor, and that might involve private equity or another listed company or another private company, this is their chance to pounce. So I agree with Scott. Don't play this on a takeover play. Only buy it if you think it's the longer term. I do see some sympathy for the view that if we keep increasing interest rates, energy prices going the way they're going, the fuel rebate has come off, the consumer may weaken eventually. In fact, that's what the RBA is trying to achieve. It's hanging in there. So the good trading update from Tyro last week might not be long-lived. But geez, cheap compared to a couple of years ago. So if I owned it, I would hold it. If I didn't own it, I would wait to see what happens with the takeover and see what their next quarter looks like, to see if the trend is continuing or if it's just a blip.
So I'll hold.
Yeah,
perfect.
Hold.
All right. Let's get into the stocks you want us to run our eye over. And the first one up, Lily wants a view, Philip, on Codan, the metal detector business based in South Australia. Also has communications division as well, but it's sort of dominated by the metal detectors, is it?
It certainly was historically. Recent acquisitions in the last 12 months, now about 52% of their revenue is communications, but that's only recent. So still historically it's been linked to the gold price, gold sector. And I think investors still think of it that way. So it's come off with the gold price. I think they had a well-attended strategy day last month, but it's trading at near all-time lows. So it sells communications equipment for armed forces, defence forces, are obviously strong given what's happening at the moment. How long will that last? Probably okay for the foreseeable future. But clearly the link to the gold price, which has been falling, is weighing on it. So for me, it's almost two companies in one. Half the business is doing well and growing, half the business is going backwards with the gold price potential, and they've acknowledged that that's challenging. Ugly chart.
Look at that, 19
look,
to $5.
If you've held on for that long, I would hold on in hope that their acquisitions continue to deliver earnings growth and that the gold price recovers. But I certainly wouldn't buy it at this price. So it's a hold for me.
Hold. And what do you think of Nearmate?
It's a sell from me. I believe it's under takeover, and it's trading at almost the takeover price. Given the register, I can't see anybody blocking it. In absence of the takeover at $2.10, I believe there's patent infringement issues being debated at the moment. So a lot of uncertainty. I think saved by the takeover. For the sake of 10 cents, I would be taking that appreciation, taking the money and run. Yeah, absolutely.
Not for you, Philip?
It's a complicated one because it's a cash burner, and in this market, I'm very conscious of cash burners. Having said that, they raised money recently at 75 cents, so they're cash funded for the near term. They've moved forward with their phase 3 trials with chronic back pain. So I like what they're trying to do. It's a good portfolio diversifier. It's a good long-term healthcare play. And if you believe consensus forecast, at one time you might double your money. It is high risk. So to Scott's point, do you want to be taking extra risk at the moment? It's a genuine bottom drawer. If you can handle the volatility and you own some other stocks, they've raised the money, so they're probably okay for 12 months. Don't look at the share price each day. It will be announcement driven. They've just put out a good announcement. The next one might be 12 months away. So for the genuine, and we're talking 3-year plus investor, it's a hold. There are cheaper stocks in the market, so it wouldn't be my first pick, but if I bought it at 75 cents, it's moving in the right direction. It's a hold.
But have they ever got through a phase 3 clinical trial approval? I've been, ever since we've been doing the call, which is sort of almost 3 years or 2.5 years, it's always been in a phase 3 clinical trial for something. I'm not sure they've ever had anything approved, have they?
No, well, I think more companies fail than move forward.
Right.
If they hadn't have raised money recently, I'd say their cash burn, they're due for a capital raise, don't be there.
Right.
But again, in a portfolio approach, I actually do like the healthcare space. It wouldn't be my first pick. I'd wait and see how quickly they move forward with the trials. You wouldn't put 100% probability on it.
No.
But the returns I think the risk return is in its favour.
Right.
But for the patient, you need to be very patient.
Okay. All right, let's go from biotechs to retailers, and 2 good ones to finish off this half hour. Ingrid wants a view, Philip, on City Chic Collective, the plus-size women's retailer.
It's an interesting company because, the market wants to dislike retail at the moment because of doom and gloom, consumer spending, etc. But some of them have been putting out cracking results, especially if you're Australian, because the Australian consumer is holding up well. More than half of their sales are Northern Hemisphere, so UK, USA, so those economies are probably going to slow quicker than ours, given that they grew faster than ours. And they have had an inventory build, and they had gross margins crunched a bit in the year, and people, generally analysts, don't like to see inventory build, and they worry about how you're going to discount. The difference,
the retailers are between a bit of a rock and a hard place, weren't they, with supply chain issue, buying up big to try and get over that, and then you get marked down for it.
Yeah, so that's what's been happening to them. The difference between plus size clothing and other clothing is it turns over, it lasts longer.
Right.
It's not as fast fashion, so you don't buy a new pair of jeans every 12 months.
Right.
So the risk is that their inventory is too good, it lasts longer, and they need to discount to clear the excess inventory. That's been reflected in the share price. So I'm tempted to say it's a buy, but at the moment I just want to see a clean print in the current financial year to see are they offloading the inventory without having to discount. How is the US and European consumer holding up? So, and that's an ugly chart. So for me, it's a hold until they give us a data point showing that, hey, you've actually cleared this excess inventory without having to discount. Your consumer's holding up okay. Then it's safe to buy. It's close to a buy, but let's see a data point from them highlighting that things aren't quite
bit more
terrible.
up-to-date information. Look, everyone loves the management, don't they? The executive team, and in tough times, that reputation sort of stands for something, doesn't it?
It does. Look, this has been a great long-term buy, and I do believe in investing for the long term. And this is a quality company that, at a particular price, it is worth owning. A couple of short-term headwinds that everybody knows about. Their trading update suggests that conditions are strong in Australia, struggling in New Zealand, and they do have an exposure to the property sector through white goods and stuff like that through the Good Guys. So it's not all smooth sailing, but the core JB Hi-Fi brand has performed well over a period of time. My main hesitance is that share price chart has gone sideways. So it's been a good business, but from an investment, good business versus good investment, from an investment point of view, depending on where you bought, it's gone sideways. And at the moment, for what it's worth, it's trading almost in line with analysts' expectations. So it's almost fair value. It's not a reason to sell it, but it's not a reason to buy it.
Right.
Given the all the concerns people are writing about the consumer, if there's any negative data point on anything consumer related, the stock will fall, and then I would swoop. I know that's being cute, but it's a great business. I'm just wondering if you might get it cheaper after a tough first quarter or something. But it's a quality business. I agree with Scott. If you bought it today, you will be happier in 20 years' time. It just might be cheaper in 12 months' time.
So you'd have it as a hold now.
For me, it's a hold. It's being a bit cute, but for me, you may get it cheaper after a couple more interest rate rises.
Let's recap. Dexus, NIB Holdings, Challenger, Megaport, and Queensland Pacific Metals, which has been in the news over the last week or so. Philip Kellen wants a view on Dexus, the big property owner, developer, and manager of commercial property generally.
It's a sell from me. If you look at the share price chart, it's basically been falling ever since interest rates have started to rise. There is an inverse correlation between rising interest rates and property investments generally. There's also what I would describe the new norm happening in the world, where demand for fixed offices is reducing because of the work from home phenomenon.
Yep.
So the demand for flexible office space is going through the roof. You know, people want the ability to work from home, work from the office. As a result, we're still not back, CBDs are still not back to pre-COVID occupancy levels. I think the expectation is for continued interest rate rises in Australia. Dexus will probably continue to struggle until we've seen a floor, until we get back to perhaps a 5-day working from the office environment, if we ever do. So for me, there's better places to put money than office space at the moment. So for me, it's a sell.
It's really interesting. I was having a chat with a tenant here in our building here at Barangaroo, and they were telling me all the partners are back full time, trying to encourage staff to come back, but you can't force them. Yeah. And if you hire anyone new these days, they go, "Oh, what's your work from home policy and how flexible is it coming in?" And on NIB Holdings, the big health insurer based in Newcastle, a bit different to the other health insurers, is it? Sort of skews a bit younger, does it? And they do lots of branded health insurance schemes for other corporates, white label, don't they?
They do. It's an interesting one. I like insurance generally at the moment because they actually benefit from rising interest rates, because a lot of the premiums they collect are invested in cash and fixed interest securities.
So the IAGs,
so they're going
QBEs,
up.
Yeah.
The complexity with health insurance, they've had a pretty solid 2 years because of COVID, because people haven't been mixing, haven't been claiming, so haven't been going to the physio. So
we haven't been injuring ourselves because we weren't allowed outdoors.
Working from home, you're not falling over in the office. So it's two contradictory forces. Eventually, the underlying profits will mean revert.
Yep.
You would think, but you've got interest rates pushing it up. And it's close to fair value. So there's no reason to sell it, there's no reason to buy it. I actually think eventually profits will mean revert, and it may struggle to outperform. And you can see it's trading below the capital raise price. They raised, I think, 150 mil recently to grow into a related area. There's no reason to own it. I'm going to say sell, not because I don't like it, but because it's close to fair value. It's trading below the capital raise price. Ultimately, profitability will fall because we'll start to claim at normal levels, and there's cheaper insurers to buy.
Yep. Okay. And Scott, the other issue, does this play into your sort of insurance sort of sector that you were talking about earlier, that benefit from rising interest rates?
It benefits from rising interest rates. It benefits from the increased or returning interest to life insurance post the Hayden inquiry. It's now a safer place to invest. As Scott was saying, they should be selling a lot of annuities at the moment because there are reasons for people to invest in annuities. Yep. Part of their business is funds management, and 38% of their funds management business is in equities, and their funds management has gone backwards since year end. So it will get marked to market. As Scott was saying, it could be doing a lot better. It hasn't. Come down to valuation. The risks, the positives and the negatives are basically balanced in the current share price. So it's not expensive, but it's not cheap. Yep. So in a market with screaming bargains at the moment, this isn't a must own. So it's a sell based on, look, it's at fair value. In the market that's cheap, you're better off investing in something else rather than something that's fair value. So it's a sell on valuation.
And as we always point out, if you've just got 20, 25 stocks in your portfolio, there are easier ways to make money than this one at the moment. Is Megaport one of them? Philip kind of wants to know. Everyone calls it a data centre business. It sort of is. It connects businesses to data centres. I also notice it's in the top 10 in terms of investors shorting it on the market at the moment. Does that play into your thinking with a stock like Megaport?
You kind of wonder why people want to short it. I think that's because of valuation. Before today's share price moves, which were strong, I think it's on something like 100 times PE or something. It's on a ridiculous multiple. That may be slightly accurate. The reason for that is Again, it's a cash burner. It's a tech stock. It'll be profitable according to analysts in circa 2025 or something. So it's a fair way. It is in the right space. It's connecting data centers. It's cloud driven. It is the future. Having said that, there are a lot of these companies around, and if you go back 3 years and you look at what projections were for today, we're not there yet. Yep. So we're now 3 years away from profitability in the space, but staff costs have gone up, interest costs have gone up, lease costs have gone up, all the costs have gone up, and the revenue's further away. It's a business I want to like. It just concerns me that it is a cash burner, and I'm cautious. I think it's up strongly today because of the tech stock bounce in the US
last night. Yep.
So it is volatile. For me, it's too early to be ploughing back into the cash burning tech stocks. There are plenty of tech stocks making money that are trading at 1 to 2 year or near 2 year lows because of the correction.
Right.
I would focus more on the profitable tech companies rather than. I want to like this company, but the reason for the short is probably because of valuation and because we know costs are going up, and we hope that the annuity stream will keep growing and hit analyst targets. 2025 is too far away for me to focus on.
And as you said, there are some good stocks in that sector as well. There Macquarie, which owns Canberra Data Centres, NextDC, stocks
Altium,
like
WiseTech,
Altium,
just in the broader tech space.
Those platform stocks.
Yeah, absolutely.
Okay.
Look, I agree. I was going to suggest 10% as well, but it depends on your cash flow requirements and how far you are from retirement. Megaport is in the right space. It is a long-term growth category. We're all moving in that direction. The price, as I said, if you can stomach the volatility, it's a bit like Mesoblast. You buy some bottom drawer, don't look at it every day, but you don't want 10 of those stocks in the portfolio. It is more, just look at today's price. It is quite volatile. It certainly shouldn't be the only stock you own.
No,
it depends on how many others you own.
No.
But yeah, it
Keep
is.
it in perspective.
Absolutely.
Yeah. All right. To Scott's point, GM has put $32 million into it, which just to get their foot on supply, to take their foot off and lose $32 million is just a drop in the bucket for them, isn't it?
It's a rounding error, but also they've committed to future, I think it was 150 mil in the future.
Yes.
So that's
If
one
it
thing
comes
this company has going for it. I mean, if you look at the chart up earlier and you can plot any battery technology company over the last few years, there's all this excitement. I've got people expecting it happens quicker than it does, and then we get bored or things take longer and then the stocks rally. This is a speculative space. It's impacted not just by the cost of the price of the commodities that go into the battery, but oil price. Oil price falls. Guess what? It's cheaper to put petrol in the car, not fuel. Energy prices continue to rise. It costs more to charge the vehicle. So there's a lot of moving parts. If it wasn't for the GM contract, I would say this is highly speculative. You don't need to be there at the moment. GM gives us some credibility. The share price has moved. Right. So it moved instantly, as Scott said. The market now knows about this. There's no new news. No one else can come over the top. So tick if you owned it. I wouldn't chase it now. If you held it, you'd probably just hang on and see how it plays out. But I wouldn't chase it at this price.
Hold it if you've got it.
It's a hold if you got it, but I wouldn't chase the space at the moment.
All right, let's recap the final 5 stocks. Dexus, a hold from Scott, a sell from Philip. NIB, a sell from Philip, a buy from Scott. Challenger, a sell from both. Megaport, a no from Philip, a spec buy. One of your 10, sort of only 1% of your portfolio, if you believe in the space. And Queensland Pacific Metals, a hold from Philip, a no from Scott. Scott Phillips from the Motley Fool, always great to have you aboard, mate. Enjoy the rest of the week. Good to see you.
Thanks, Koshy, and you. Nice to see you, Philip. Bye, guys.
Philip Pepe from Shaw and Partners, likewise. Good to have you.
Thanks, Koshy.